The Federal Reserve just did something they haven't done in over 20 years. They hiked short-term interest rates all the way up to 5.5%. The last several times they've done this, it caused a big collapse in both the stock market and the housing market. If you're a home buyer or real estate investor, you need to be tracking what the Fed's doing very, very carefully because it could push the U.S. economy deeper into recession, something that could cause both home prices and stock prices to decline further. And to talk about these Fed rate hikes and their implication on both the economy and the housing market, I have a special guest, Adam Taggart from the Wealthion YouTube channel. How are you doing today, Adam?
Doing great, Nick. It's always a pleasure and a whole lot of fun to be with you on your channel.
First, I want to talk about asset prices and asset markets right now, because when I look at the Fed funds rate and I see it now close to 5.5%, and I compare that to, for instance, what the S&P 500 is trading at, I see the stock market right now is near an all-time high when, the last time interest rates were at this level, the stock market was trading 70% lower and there was a big crash in the stock market. And it's a similar story with housing. So my question to you is, why haven't home prices and stock prices gone down by more in response to these higher interest rates? And do you think at some point over the next, let's just say 6 to 12 months, they will start going down in response to these higher interest rates?
Yeah, let me answer the second part first, where I think, yes, I think the high probability is that they are going to start succumbing to this increased downward gravitational force. A lot of it has to do with investor sentiment, investor appetite. In the case of stock market, probably three big factors going on. One, we had one of the worst years on record for both stocks and bonds in 2022, and things just got very oversold. And we got deeply oversold levels by the end of last year in October. And you just had capital recognize that and start flooding back into the market. At the same time, you started having, a new narrative in the marketplace, which was AI and how AI is going to transform the future. And we basically we've had a mania go on in AI stocks, which interestingly, many of the stocks that are benefiting the most from that happen to be the biggest stocks in the major indices, right? So as those stocks go up, they drag the indices up with them. So you've had the indices rebound pretty strongly because of this effect. And then what you get is sort of this knock-on momentum effect, right? Where people start piling into the market because the market is going up. And then the more capital that piles into the market pushes the market up even more. And you kind of get this virtuous cycle where people start chasing the market higher and FOMO comes in and whatnot. The last
Dare I say, just to jump in, Adam, dare I say that explanation was very good, and it reminds me of a bubble. I mean, that sounds like animal spirits there, where maybe there's a couple slivers of legitimately good news, like developments in AI, but then everyone just jumps on that, and all of a sudden the stock market is now close to the most overvalued it's been in the last several decades. Would you call this like a bubble or bubble-like behavior?
I would absolutely call it bubble-like behavior for absolutely certain in the AI space. When you get a company like NVIDIA, look, a historic PE ratio for stocks on average is somewhere in the 12 to 15% range.
Can you just explain real quick what that is for my viewers?
Absolutely. So stocks are roughly based on what are called PE ratios, where the price of the stock is a function of two things: the earnings of the stock or the expected earnings of the stock, and then a multiple applied to those earnings. And if you expect earnings to grow aggressively over time, that multiple you're going to place on the stock is higher, right? So you have sort of two factors that can push a stock price up. The company itself can increase its earnings, or the market can increase its estimation of how fast or how slowly those earnings are going to grow. And that's going to impact the multiples. I said sort of historically, it's between, depending on the type of stock in the market, anywhere from 8 times for a slow, steady Eddie type company to maybe 15 times for a higher growth company. We have stocks now. Many stocks in the high growth space are trading now at 30+% PE.
Yeah, what's NVIDIA trading at? Do you know what NVIDIA is trading at?
Well, NVIDIA, I don't even know what it's trading at a PE ratio. I know what it's trading at from a sales price to sales ratio, which is something like 40 times, right? So the price to sales ratio should be far below your price to earnings ratio because the sales is a much bigger number.
The NVIDIA PE ratio I just checked is 236.
There you go.
The stock price is trading 236 times their trailing 12-month earnings. And thank you for describing that, Adam, because actually my viewers who watch me for real estate will be familiar with PE ratio because I use something very similar with the housing market.
It's
looking
like
at
a cap
home,
ratio. The
looking
cap
like home prices relative to incomes. And very similarly, we're in a situation right now where home prices are trading at a record level relative to income. So right now, home prices are trading at 4.5 times the median household income in America, when it's normally 3 times the median household income in America, suggesting home prices are 30% overvalued. So it's interesting how these two different asset markets, real estate and stocks, they're different in many ways, but they're both behaving similarly, and that their prices are way higher than you would expect given the fundamentals of income and earnings. And so I guess the question is, what would need to happen, in your view, Adam, to start bringing these prices down to more affordable levels, back to what the fundamentals support in stocks and housing? Do we need to see something happen in the economy? Does the Fed need to hike interest rates by more? What do you think needs to happen?
Okay, I'm going to try to answer that question in the inverse, which is what would need to happen to justify today's numbers, right? And we would need to see a tremendous increase in income and earnings over time, sustained over time, to basically earn their way up to what today's prices are, right? So we've kind of pulled this rosy valuation from the future into today, and we need to earn that out in the future to justify that. Now, looking around at current growth rates, they're nowhere near that trajectory. In fact, corporate earnings rates are still actually in decline, and personal household income levels are, on a real basis, they've gotten a little bit of a bump relatively recently, but it's marginal, right? So if you just look at what's needed to sustain today's prices, we don't see a pathway, I think a credible pathway to do that. So to your
Let me
point,
just understand that, Adam. So basically, you're saying the company's earnings, which need to go up a lot into the future to justify their stock prices, well, the earnings are still going down year over year on the earnings reports. And then people's incomes are only going up like marginally. So how can these valuations be justified into the future if we're not going to see those growth rates?
well, they really can't. So when you sort of a famous example of this, when during the dot-com boom, Scott McNealy, who was the CEO of Sun Microsystems at the time, I think it's something like was it a 10 times price to sales ratio or 100% price to earnings ratio? But he basically said, all right, Wall Street, let me just get this straight. He said, to justify this current valuation ratio that you're giving me, I would have to give 100% of the earnings of my company, of the revenues of my company, to you for the foreseeable future. I wouldn't be able to pay wages. I wouldn't be able to pay taxes. I wouldn't be able to pay cost of goods sold. I would have to take basically every single dollar that came in the door and give it back to you as an investor for the next, decade or so, to justify the current price that you're giving me. And he said, I can't operate a company like that. It's magical thinking, right? So that's the situation we're in right now, is that we're putting these gargantuan valuations on, well, some of these AI companies for sure, but many stocks, many houses, where we're basically pricing it at a value where a credible analysis of what the actual local incomes in the case of housing could provide, or what these companies are credibly likely to make over the next, projected period of years. The math just doesn't add up, right? So I think we kind of come down here, Nick, to if you are trying to play in either of these markets, right? If you're going to be a buyer of stocks, if you're going to be a buyer of real estate, you have to ask yourself, what do I believe in more? Do I believe more in momentum, or do I believe more in fundamentals? Because if you look at the fundamental side of the story, as you and I have been talking about, and I'm sure we'll really get into the details in this discussion, the fundamentals just do not justify current price levels nor the optimism for where they could go. But right now, we have certainly a bit of a mania going on again in the stock market. And in housing, we have transactions have cratered. We'll talk about how some key elements of the market are indeed showing signs of cooling off. But from a price perspective, if you look nationally, prices really are close to their all-time highs. And we're hearing a lot of people talking about like, hey, all these guys like, you and other channels like yours, Nick, and channels like mine that have been warning people about a potential coming real estate market correction. They're saying, guys, you're wrong. We've had mortgage rates double and prices have barely budged. Right? There's a reason for that. Maybe we can get into the details for why it hasn't happened yet, and yet being the underlying and important word there. But people have to make a choice. You either have to believe the momentum is going to continue, and certainly continue long enough until the time you want to sell, you'll be able to capture a gain. Or you have to say, you know what, like this seems to be getting ahead of its skis, just like the market was in 2001, just like 2021, 2008, 2000 period. We have lots of precedent where the market has gotten overly exuberant. And you've got to ask yourself, okay, maybe we're seeing the same thing here, and I should maybe not buy and position myself for a bust and then maybe be well positioned to come in and buy at good value once the dust settles.
Yeah, and I think one quote is ringing true in my head after what you just said is you can never change the price you pay for something, right? Whether it's a stock or a house, the same stock or the same house could be a good or bad buy depending on the price you pay. And the prices right now are literally at all-time highs, adjusted for inflation, adjusted for income, as we've discussed. And I want to seize upon that point you mentioned of magical thinking, because this magical bubble-like thinking, as you're saying, it's completely contrary to the fundamentals we're about to talk about. And, when I look at, the interest rates that, we started discussing, I understand why people would have magical thinking when the interest rates were close to zero, right? Because it really primed assets to go up. But now interest rates are close to 5.5%. The Fed increased rates. And so the magical thinking hasn't stopped. So I'm going to ask you, what needs to happen to stop the magical thinking? Is it something that's going to need to occur in the labor market? Are we going to need to see the unemployment rate go up a lot? Or maybe consumer spending? We'll have to see consumer spending go down. What's going to pierce the veil on this magical thinking and potentially convert it to panic?
So at a high level, I liken it to human behavior, right? There's two ways to change your behavior. One is you project out proactively, okay, if I do A, then B is going to happen, then C is going to happen, and D may be a result that I don't want. So let me change my behavior today. Sadly, most of us don't do that. People change by pain. It's basically they just keep doing the same thing up until the point that the status quo, the pain of continuing the status quo becomes higher than the pain of changing. And I think that that's what's going to be how we end up reacting here. And the individual example of this is the overweight person with an unhealthy lifestyle that doesn't change their behavior until they have the first heart attack, right? That's what finally wakes them up here. I talked to, on my channel over at Wealthion, I talked to a lot of experts in the economy about this exact question. And the folks that really study business cycles say, there's a pretty predictable pathway where we sort of fall into recession. And one of the best proponents of this is a guy named Michael Kantrowitz, and he has this framework, which I think I might have mentioned on your channel once before, Nick. It's called the HOPE framework, where it shows how an economy sort of slows down and falls into recession. And H stands for housing, O stands for new orders in the economy, P stands for profits, corporate profits, and E stands for employment. And we've basically seen weakening indicators in the first three letters of this acronym, the H, the O, and the P. The employment numbers are the ones that have held steady so far. And a lot of people are pointing to that and saying, hey, that is the resilient bulwark against recession, and that we don't need to worry as long as employment remains strong. And the unemployment rate right now, I think is what, at like 3.6%. It's still close to record lows. And first of all, I think we are probably going to need to see a cracking of the employment rate numbers. And Nick, you and I may want to spend a little bit of time digging into exactly how much we feel we can trust the current.
Yeah. Let's do that, Adam. Because I think what you're saying is the employment numbers are very important, right? So long as the unemployment rate's 3.6%, people are going to be fine living in magical fairy tale land where they're paying record prices for houses and stocks, even though the fundamentals don't make sense. So, but the one thing that, the more research I've done, and I think the more research you've done, you realize that the government reported statistics on employment, it's maybe not so much, they're not lying about the employment numbers, but let's just say there's some degree of misrepresentation when people just look at the overall job numbers, which look solid. But, when you dig in under the hood, you see that they revise down the jobs figures each month. They've revised down jobs every month so far this year after they announce it. But I was just talking to you, you said there's some interesting observations you had on the type of jobs that are being added and subtracted from the economy and how that could actually indicate that the recession is closer than people think.
It's absolutely true. So I talked about these experts who study cycles in the business cycle. And so they have these progressions that we see time and time again as the economy slows down and falls into recession. I mentioned Michael Kantrowitz and the importance of the E, the employment, in his HOPE framework. So I was talking to another analyst, and he had a chart that hopefully you can pull up here as I'm talking about it, Nick. This is Eric Basmajian. And what he does is he looks inside each of those elements of the economy, each of the H, the O, the P, and the E, to see how the indicators within that slice of the economy are behaving. So in the case of employment, what Eric does is he looks at leading indicators, coincident indicators, and then lagging indicators. And the chart I think I sent you has the leading indicators and then two coincident ones. I don't think it has the lagging indicator data in there. But if you look at this, this shows what you would expect to see in a slowing economy. right? Where we don't go from a record low unemployment rate to a record high unemployment rate overnight. It takes some time. So what would you expect to see? Well, first you'd expect to see your leading indicators begin to worry. That's the chart here on the left. As you can see, it's flipped negative, right?
And those leading indicators are, it looks like residential construction jobs, manufacturing jobs, trucking, and temporary help services. So these are the types of jobs that would get cut first
Exactly.
in an economic downturn. And we are seeing them get cut over the last 6 months, even though the headline job numbers still look quote unquote strong.
Exactly. And then if we look at the two other charts here, the coincident indicators, they haven't flipped negative, but if you look at their trajectory, it's weakening, on a period by period basis here. So it's slow. It's showing you that the employment market is slowing down here. Now, like I said, the lagging indicator chart isn't here. Eric said that it's largely sort of flat right now, which no huge surprise. It's a lagging indicator. It's the one that's going to respond last. But what's valuable about Eric's work here is it shows you where we are in the story. Leading indicators already in recession levels, coincident indicators getting on their way to that same fate. Lagging hasn't really quite started to move yet. Of course, when we start to see the lagging indicators move, we're going to know that it's really game on. So tracking indicators like this are going to be really important to know, what's going to be happening next and know when we really need to be putting on our seatbelts and assuming the crash position.
Yeah, thank you for explaining that. And one thing I want to move on to talking about here, Adam, is this other headwind. Building and building. It's actually happening right now. Not a lot of people are paying attention to is the banks and the credit crunch and the fact that banks are starting to cut loans from their balance sheet, not refinance loans, and that's starting to take money out of the economy. And what do you think the impact of this credit crunch is going to be, and how's that going to interact with all of the other things we've talked about?
Well, a credit crunch, the impact of a credit crunch can't be overemphasized. Credit is the lifeblood of the economy. And so when credit starts contracting, it's literally like having someone siphon the blood out of your circulatory system. So if we have issues in the credit markets, we're definitely going to have issues in the economy. One thing to keep in mind about what's going on in the banking system is, we started this conversation with the latest update from the Federal Reserve, right? The Federal Reserve is the country's central bank. It's trying to fight inflation by slowing economic growth. And it's doing that by increasing the cost of debt, right? That's what increasing interest rates does. And it is siphoning liquidity out of the market through its quantitative tightening program. Those things should, and I believe very much will, have a big dampening effect on economic growth. The vast majority of the impact we have yet to see for something called the lag effect, which you and I will talk about in a bit, Nick, because I think that is the single most important thing your viewers should take from this video. But what's key to know about your question here, Nick, about the banking lending tightening is that is all happening on top of what the Federal Reserve is doing, right? So we have what the Federal Reserve is doing, which I think we can make an argument is already risking over tightening and ending up creating a recession that could be worse than what the Fed would like to engineer here. And yet, on top of what the Fed is doing, the banks are putting their own dampening effects on the economy. The risk here is that we could end up getting into a recession that is almost more towards the depression side of recession than the soft landing side. Is that going to happen? I don't know. We'll be tracking it and we'll provide lots of updates for folks along the way. But I think that's the risk that you've got to be careful about here when we look at what's going on in the banking system. And if I can just give one note here from Lacey Hunt. Lacey Hunt was a senior economist for the Federal Reserve of Dallas. He's been a senior economist to many of the world's largest banks. He now runs a bond fund. But here's what he said about the bank tightening. He said, in previous cycles, real bank credit did not turn negative on a one-year basis until the economy was already in recession. So we didn't see a contraction of bank lending until we were already in recession. Even in the global financial recession, the 12-month change in real bank credit did not decrease until the end of the recession. But in the latest 12, 24, and 36-month rates of change in real bank credit, they are all negative. And he says, as the second quarter ended this year, the one that just ended, the contraction in bank credit showed the markings of an old-fashioned credit crunch. Now, Lacey's in his 80s. He's been around the block a lot. He's seen more booms and bust cycles than almost anybody alive. He's worked with the great economists like Milton Friedman. He knew Paul Volcker personally. He's been around the block. He's basically saying everything I see right now shows that we are going into a quote old-fashioned credit crunch that could really throw a wrench into the whole economy here.
I mean, that's something that is scary, Adam. And just to make this like real for people, bank credit, what does it really mean? it basically means that banks are not loaning money out, right? I mean, that's what this is basically saying. And the
Yeah,
rate of them
it's more
loaning
expensive.
money is
It's more expensive to
declining.
get a loan if you can get one, right?
If you can get, it's right. It's a double whammy. It's more expensive to get one, so the demand for loans goes down, while the banks also tighten the supply of loans into the economy. And that's basically going to mean businesses, when they're up for refinance, are maybe they're not going to be able to get a new loan, or the loan they get is going to get cut from the loan that they had before. It's going to mean households aren't going to be able to raise their credit limit as much into the future. It's going to mean potentially that there's more stringent underwriting standards for mortgages, for houses and commercial properties. And so that's happening as we speak right now. The beginning stages of that are in full force. As you said, bank credit is almost negative on a nominal basis and is negative in real terms. And yet it's amazing how people are just discounting it. Like it's not a big deal. Every other time we've seen this type of bank credit tightening, we've had an economic downturn. And like you said, in some cases, a depression, especially with the money supply being contracted right now. And so why don't we segue now into talking about the lag effect, which you've mentioned a couple of times, because I think this will help explain to my viewers out there why we have all these things moving and showing a downturn and that prices are going to go down, but it hasn't happened yet. So let's talk about the lag effect and why it's actually normal and expected for these things to take some time, for the economy to be kind of a slow moving ship when it turns.
All right. So this is the most important thing I think folks should take away from this. And let me answer by describing what's going on with interest expense in corporate America right now, because I think it might give you a good sense of what's going on. So historically, when interest rates go up, the percent interest expense at a company that goes up. And what that does is that depresses profits for the company, right? The company's paying more in interest because the debt is more expensive. That eats into their profit. They have less profit left over. What's interesting right now is we're actually seeing the opposite, right? Which just doesn't sound very intuitive, right? Why is that going on? Well, the reason is because debt was so cheap before the Fed started this latest hiking campaign that when the Fed first started raising interest rates, corporate America said, oh, wow, rates might be going up here. I need to load up on all this cheap debt. So they did. And so what's happening right now is companies are sitting on that cheap debt. They have a lower interest expense. And because rates have gone up so much over the past year and a half, they're now able to get a much higher return on their corporate cash balances. So they're actually benefiting in two ways. They've got low interest expense, and now they're getting higher than what they were getting before, substantially higher than what they were getting before in interest income from their cash reserves. Now, what's interesting though, is that this is all temporary, right?
So, Adam, I need to stop you right there. So just so I got this straight, you're saying that higher interest rates should be bad for corporations, but thus far it's been good because they're basically getting the benefit of investing their excess cash in savings accounts at 5% or CDs or US Treasuries at 5%. So they're getting the benefit of the increase in rates, but because they locked in the low rates before for their debt, they're not seeing the cost yet. So do I have that? So in the first year of the hike cycle, it's been beneficial for corporations, but that's not going to last.
You have that exactly right. And the reason why I started with this is because I think people look around at corporate America and say, hey, it's actually doing fine with these higher rates, right? Everybody was worried about the higher rates, but corporate America's hanging in there just fine. So why worry, right? Then we get to the lag effect, right? Which is it takes a while from when the Fed pulls a lever, like raising the interest rate, for that to ripple into the economy, because you have to wait for things like the companies that are sitting on low debt to get to the point where that debt comes up for maturity. When it does, they then have to go out and raise more debt. But now the cost of debt's much higher. In fact, today versus a little over a year ago, the cost of that debt is probably going to be about 2 times more than what it was. So all of a sudden, we are going to see company after company having to refinance its debt. Those interest rates are going to re-rate. The cost of that debt's going to re-rate. And all of a sudden, we're going to see that percent interest expense spike in these companies. And then it's going to go from a net benefit to a net injury to these companies, but it takes time, right? So that's, I think, a good illustration of the lag effect, which means because it didn't happen on day one, doesn't mean it's not going to eventually come into bite later on in the future.
So let me just zoom out and ask you a question, Adam. One of the ways I started initially thinking about this downturn was thinking of it in terms of 2008, as far as like ferocity, right? Like the 2008 downturn happened slowly at first. And then in 08 and 09, like huge declines in both the housing and the stock market. And then things kind of like bottomed out and went down for a little bit. Do you think that this could be like, are we still walking into a situation like that? Or could this be more of like a long, drawn out slog where employment and asset prices just incrementally go down for years and years? Like, could that be an outcome here?
It certainly could be an outcome. I would say the biggest factor here will be the Federal Reserve's response to the arrival of a recession. Does it go full guns blazing the way that it did during the pandemic, where we just released a gargantuan amount of stimulus that nobody could have ever thought the governments would be willing to do beforehand? Or is it more measured, right? And I'll cut to the punchline on that. I asked the same question to Lacey Hunt in my interview with him the other day, and he falls on the more measured side of things. He thinks that the Fed crossed an unnatural line during the pandemic that it does not want to cross again, because it finally woke the inflation monster that it's been fighting ever since. But let me tell you why I think it's going to. I think the likelihood of it being longer than, say, like a 2008 correction, which was pronounced, but it didn't really arrive, at least in terms of the financial markets, until end of 2008, and then it bottomed in March of 2009. Like the pain was relatively short-lived for investors. It was painful. It was a big drop, but it was relatively compressed. And then the market basically picked itself up and pretty much went up in a straight 45-degree line for like 12 years. One of the reasons why I'm not sure we're going to be seeing that movie play over exactly is, let me, if I can, just explain for your listeners how I think what the Fed is doing and how the lag effect plays into account. As we mentioned, the Fed is trying to slow the economy because it's trying to bring down inflation. The Fed has gone on the most aggressive hiking campaign we've yet seen, and the economy hasn't slowed that much yet. And the Fed is looking at some of this data that we've been talking about, Nick. They look at the employment numbers. Unemployment's still really low. So the Fed says, okay, I got plenty of room to keep tightening here. The economy is still growing at 2x%. Okay, I want to slow it down. An important thing to note about Powell is he's much more confident he can stimulate a too slow economy than he is about cooling a too hot economy. So if he's going to err here, he's going to err to the side of doing too much. So again, I wrap all this up just to say, I think the danger in the current environment we have is that everybody thinks the economy is way more resilient and robust than it truly is. So that when it does stumble and things do begin to crack, we're going to have an impaired economy. But then for quarters, it's going to keep getting slammed into by the lag effect of all of the policy decisions that have been made already over the past year. So even if the Fed starts changing policy on a dime, there's going to be a period, probably measured in quarters, where this injured economy is going to be lying on the ground, just continuing to get kicked in the teeth by the force of this lag effect.
Yeah. And when you think about that lag effect being Fed rate hikes and banks tightening credit at the same time,
exactly,
that's when you start to be like, whoa, all right, like something real could happen here. I'm just going to offer my own opinion. You can tell me what you think about this. I think they're going to, when the signs become clear of the economic downturn, I think they're going to ignore it, because I think what the I'll call it propaganda I'm starting to see built up in the mainstream financial news, especially with the housing market, is they're just starting to ignore all the obvious things. No one's reporting anymore that home sales are at their lowest level in 15 to 20 years. Or mortgage applications are at the lowest level in 15 to 20 years. Like, no one's talking about that anymore. They're talking about the fact that prices are up in the spring, which they're always up in the spring. And so it's almost like the narrative has shifted in a way now, full on bullish narrative, that I think even as the negative things continue to stack up, I think they're going to be ignored. And when I look at the fact that the Fed now no longer thinks that a recession will happen this year, they came out and said this today, that recession in 2023 is no longer in their forecast. Well, if the Fed is coming out and saying that, they're not going to reverse their course on that anytime soon, right? It's going to make them look bad. And so my personal opinion is that they're going to ignore the things that start stacking up and looking bad until the last minute, until it becomes too obvious to ignore. And I'm curious what you think about that.
Yeah, I would say in general, I agree. Like I said, the Fed, Powell has been incredibly specific and consistent. Like I said, he said, we're not letting up at all until inflation is at our 2% bound. Doesn't mean he's going to continue hiking until it gets to 2%, but I think it means he's definitely going to not start reversing policy until inflation is, at 2% or very clearly about to hit it. And so, like I said, I think he's okay if for a while it looks like he over tightened, right? And the economy starts taking some damage. In fact, he was asked about that today. And, he basically said, look, my base case is, I don't think we're going to have a recession. I think I'm going to be able able to engineer this soft landing, but you don't know. But it's not a reason for him to take his foot off the accelerator here. And by the way, Nick, too, I don't think a sitting Fed chair would ever say, I think I'm going to create a recession. It's just not in their job description to do that. One reason is they'd be afraid of it becoming a self-fulfilling prophecy, right? If they outright said, I'm trying to create a recession, people would change their purchasing behavior today and probably hasten it. So to a certain extent, we shouldn't look at the Fed to warn us about recessions because they probably never, ever would. Yeah.
Sure. No, it totally makes sense, Adam. I think there's one more point I just want to talk about. A lot of my viewers have been talking about this in the comments section related to its impact on the economy. It's like yet another headwind is student loans and interest payments on student loans. So basically been frozen for over 3 years now at this point since the pandemic started, and they're going to be reinstituted soon. I believe in the next month or two. People with student debt are going to have to start paying interest on that student debt again. And do you have any thoughts about what that's going to mean for all this calculus we're talking about, especially related to consumer spending, which is going to have an impact on earnings growth for stocks and also the unemployment rate? How do you see that playing out?
I think repayment's going to be a big deal in a negative way for the economy, and I don't think it could come at a worse time. So just some quick numbers for your listeners here. 40 million people have outstanding student loans. Total amount of that debt is $1.75 trillion. It's huge. The average debt, I've seen a couple different estimates, but it's somewhere between $28,000 and $38,000 per borrower. 92% of these loans are owed to the U.S. government. And that's a whole different side conversation for us, Nick, but a huge reason why we have the big issue we have with unaffordable education, higher education, and these tremendously, I think, morally repugnant student loan balances that so many people carry. It's a classic result of government getting involved in a free market and basically making everything worse. When I went to college, the vast majority of loans were given by private lenders, but about 15, 20 years ago, the federal government really got in a big way, pushed out all the private lenders and just completely distorted the price of education, because basically it gave the colleges the incentive to hike costs as high as the market would pay. And with a cost agnostic lender like the government was just happy to write the check. So anyways, 50% of those people are going to have to pay at least $200 a month once these loans go back into repayment. 20% of them are going to have to pay at least $500 a month. That's going to be about a $70 billion annual hit to consumer spending. Not the end of the world, but you add that on at the margin of some of these lag effect issues we're talking about, it's really going to start biting. We've had these people who I sort of talked earlier about changing by proactivity or changing by pain. A proactive person would have said, look, at some point, these loans are going to go into repayment. I should just keep making payments and get my debt balance down, or I should be putting this money into a savings account. So if indeed they don't get forgiven and I have to start paying again, I've already saved up the payments I should have made. Almost nobody did that. Instead, people just went and, spent that money on, discretionary items and experiences during the past 3 years. That
either way, it's a problem though, because if they were saving it and increase bank deposits and then they have to spend it on interest, that's going to lower bank deposits, which is going to make the credit crunch worse. Any way you slice this, right? The theme I'm getting is that there's going to be less and less money available in all these different sectors of the economy. Is the overall theme I'm getting from this conversation. And so if there's going to be less and less money available in all these sectors of the economy, with all the asset prices and inflation so high and the price of goods so high, well, how can it sustain itself? It can't sustain itself.
Let me just add one more domino to this. And then I do actually, if we can, talk about housing for a moment, more specifically, because I know it's of great interest to your viewers, but you're sitting in a very interesting position. I'd love to get your thoughts on it. But when I was talking to Lacey Hunt, the thing that he said is sort of the most important metric in this whole soup of the economy is productivity. So goes the productivity of your workforce, basically goes the destiny of your economy. And productivity in the US economy has been on a really bad downward streak. And so he said, basically at this point, the only way to reverse that is to rationalize your workforce, to bring the cost of your workforce in alignment with what its output is. And that's sort of fancy diplomatic economist speak for there's going to have to be substantial layoffs, right? So what you were just saying, Nick, is yes, for everything we've been talking about, like the trends are not good, right? But we haven't really talked about the impact of what substantial layoffs would do to this situation. And of course, they would just make it tremendously worse, right? People lose their incomes. They can afford to spend much less in the economy. They, can afford to spend much less for a house, right? So all of these other asset classes that are propped up on what incomes are able to afford right now, as we start taking away dominoes like, oh, okay, yeah, they had student loan forbearance, we're removing that, they're going to have to start paying that again. Yes, that's a pretty material or injury. But if all of a sudden we just start taking away the income for a material percentage of households because people are actually losing their jobs, that just adds the whole thing on steroids. So we've got to be really cognizant of the risk here of what layoffs will do on the overall equation here.
I think that's a great point, Adam. And that actually brings to mind two different metrics, right? It's the unemployment rate being at an all-time low, and then asset prices being at an all-time high, right? Let's just talk about inflation-adjusted home prices, or home prices relative to median income are at an all-time high. Well, the unemployment rate's at an all-time low.
Mm-hmm.
And you just got to ask yourself, how sustainable is that?
How sustainable is that? Exactly.
And that's never been sustainable in U.S. history before. And so unless there's this massive, this time is different situation, which is ultimately what people who are bullish on the economy and housing market and stock market, this is what they're saying. That's ultimately their real argument, is they're saying co-opted version of this time is different.
Right. And sorry to interrupt, but what they're saying by saying that is, and therefore we're going to return to robust, higher than average, sustainable economic growth, right? So if you're going to say this time is different, you have to have a rationale for why that return to above average and sustainable economic growth is going to happen. And beyond just AI is going to change everything, there's no credible vision for that I've yet seen. I'm totally happy.
That's a great point, Adam, just to reemphasize what you just said. It's not even as if the people who are bullish are saying that the crash won't happen. Like, they're saying that growth is going to be amazing going forward, because that's the only way that the multiples on stocks and housing make any sense, is if the growth in wages and spending and earnings is huge. And so it's just so important for people watching understand that the only way out of this bubble that doesn't involve a crash is for massive levels of growth. And if you're an investor or homebuyer, do you think massive levels of growth are coming with all of the headwinds we discussed? And ultimately, you got to make up your mind.
Let's go down to this. How can you make an argument for massive increase in growth when the cost of capital, right, the cost of debt, the cost of doing business has just dramatically increased the way that it has over the past year and a half?
While the banks are cutting lending, I mean, you can't.
Right.
I mean,
and then you add, if you add any kind of material layoffs into that mix, I think the credibility of any such argument gets stretched paper thin. So anyways,
it's a great point, Adam. And thank you for this discussion. I mean, this has been fascinating, super educational for my viewers. If you guys haven't watched Adam on his YouTube channel yet, the Wealthion YouTube channel, you should. He interviews a new financial and stock market real estate expert every single day on his channel. I've learned a lot from watching those interviews and, of course, talking to Adam. So go check out the Wealthion YouTube channel. But before that, let's just conclude the conversation by talking about the housing market, because there's lots of confusion out there right now. A lot of the mainstream reporting is saying that we're in a housing market recovery and that there was never a downturn or the downturn's over. But of course, all the other kind of fundamental indicators on the housing market are still terrible. Home sales are near the lowest level in 15 years. Prices have only gone down a little bit and are still at about 30% overvalued compared to the fundamentals. So I want to ask you, Adam, what do you think about the current situation in the housing market? And what are maybe some of your predictions about where that's going to go going forward?
Okay, well, I'll make it easier on your viewers and say that my predictions are very similar to yours. And actually, I take a lot of your work into account in my predictions. So, I think this 30% overvalued is a good finger to the wind number of where we think housing prices should likely go once the dust settles, if the shoes that you and I think are going to drop actually do indeed drop from here. But the best kind of answer I hear people give to why the housing market isn't going to correct is because we have all these people that are sitting on low mortgages and they're just not going to sell, right? And people sort of use that as a catch-all of like, okay, so if the sellers just refuse to sell, prices aren't going to come down. I think that's a fallacy for two reasons. One, as you and I have discussed before, housing is priced at the margin. And you could have all the sellers collude together to say, we're just not going to sell our homes come hell or high water. There's still going to be some organic transactions that happen, right? Deaths, divorces, job loss, people having to move for their jobs, that type of stuff that are going to force some percentage of the housing inventory to turn over. And that is what's going to set the price discovery for the market. And yes, it may take longer because you have fewer transactions, but it doesn't mean it's still not going to happen. So that's reason number one. Reason number two, and this is my question I've been wanting to ask you, is how much pricing power do sellers really have anyways, right? They don't have the ability to permanently set the price of the market. They can slow price discovery, but they really don't have the collective power to stop it, do they?
No, they don't. It's a great point. And I'm just going to give an example. Where I live in Nashville, it's very interesting for me to track this market over the last 6 months, because in the spring, I saw what a lot of people are now seeing in the data on home prices. I saw all of a sudden sellers started listing their prices like much higher in the spring for no reason. Like there was actually no justifiable reason for sellers to list their prices higher when you looked at things like inventory and days on the market. All those things were going up, but the sellers were just increasing the prices in the spring. But you know what they're doing now, Adam? In the late summer, mid to late summer, they are now dramatically cutting the price. And there's empty open houses everywhere. And so what we're going to see over the next 3 months is we're going to see huge price cuts on the order of what we saw last summer and fall. And I think people really got deluded into buying into a springtime increase in home prices, which is normal. People got deluded into thinking that that was somehow a sign of recovery, when even in 2007 and 2008, prices went up in the spring. And prices basically traded sideways year over year for a good 18 months before the bottom really fell out. And so to answer your question, sellers are going to list when they feel forced to list. And this is the one aspect that we have not seen yet in this housing downturn, is the kind of corresponding recession or the corresponding liquidity crunch for homeowners that causes people to have to sell their primary residence or their second or third residence. Maybe they lost a job, they had a bankruptcy, they need the money, so they sell their house. We have not seen that hit, but we will see that hit at some point as the economic downturn gets worse, as the Fed continues to take money out of the system, and as interest rates continue to go up. And so my biggest thing is, if you're tracking the housing market, do not get deluded into thinking that this is over. In fact, the beginning stages of this downturn are very normal for a housing downturn. It's normal for prices to go down a little bit over the first year, but then have another leg down when the recession gets worse.
It gives you a sense of the magnitude of the potential correction here, right? The bigger the divergence between market prices and fundamentals, that's the measure of the potential pain that may be brought into the system.
100%. It all goes back to, okay, how would we avoid a housing downturn? Well, rents and incomes need to surge. That is the only way that we could avoid a massive housing downturn, is if rents skyrocket out of control and if wages start growing on the order of 8-9% a year.
Right.
If that happens, I'll fully admit, if that starts happening, then the overvaluation will be corrected through higher wages and rents. But
and I'll join you in revising upwards, my expectations for home values. But just to track where we are right now, right? Real wages just finally eked out a positive reading after something like 20 plus months of negative declines. And rents are now actually declining, right?
Yeah, rents have now officially slightly on the decline in nominal terms year over year. And nominal wages, which is what I track for the housing market, are up about 3.8, 3.9% year over year, which is okay, but not nearly what it needs to be to keep pace with how expensive the housing market has become. And so, again, it goes back to this discussion of growth. Do you think we're going to see huge growth into the future? If you do, then maybe you should buy a house. Maybe you should buy stocks. But if you're someone who is looking at our conversation today and thinking, oh, wait a minute, yield curves have heavily inverted. LEI index is saying that there's a recession. Consumer spending is flatlining. Student loan repayments are coming. The banks are cutting credit. The Fed has hiked interest rates the fastest that they've done like in 40 years. Whoa, okay, well, in that situation, growth is not likely to occur, which makes declines in asset prices the most probable outcome. All right, thank you for coming on the show. This was a terrific conversation. Why don't you just let my viewers know where they can find you to track what you're doing?
Thanks so much, Nick. And let me just first say what a huge fan I am of what you're doing here with Reventure Consulting. Huge fan of your videos. Huge fan of your mission, huge fan of you personally. As your viewers may or may not know, you and I have, this discussion today has basically just been a video version of a lot of the phone calls that you and I have every couple of weeks. I really enjoy discussing all this with you. But folks, if you enjoy understanding what's going on in the macro side of things, if you like this macro data, if you like understanding what's most likely to happen in the economy and the markets based upon the real-time developments in this soup of metrics and indicators that Nick and I are talking about, I have videos practically every day on my channel, as Nick mentioned, with leading experts in economics, in investing in money. And you can go watch those over at youtube.com/Wealthion.
Terrific. Thanks, Adam.
Always a pleasure, Nick. Thanks, buddy.